In Chapter 3, Module 3, we're going to be looking at transactions. So I'm going to start with this mini exercise. It's mini exercise M-M3-11 out of your textbook. And I'm going to go through it twice. I'm going to go through it the first time using the accounting equation, um, what they call the financial statement effects template. And then I'll go through it again doing the journal entries in M3-12 and posting them to T accounts. Now, when we talk about the general ledger of a company is kind of like a log, but it only records the financial things that happen, right? It doesn't record promises for the future, this and that, unless it is accompanied by a simultaneous transaction. So, for example, if a company goes to a bank and secures what we call a line of credit, basically a credit card for a company, um, they do a line of credit, there would be no entry into the journal at that time because nothing actually took place except an agreement that they will lend me money if I require it. Right now, if I decide to borrow $10,000 on that line of credit, now we will record a transaction that I get cash of $10,000 and that I owe them $10,000 back, plus a note that that there will be interest on top of this um, transaction. So let's start out here. We have the various ones. I'm going to move this aside. You can follow along in your book, or you can just trust me to read it. So B. Fisher, well, let me set up the structure first. You're going to have assets, liabilities, owner's equity, and then we're going to draw a line down here, and this is going to be revenues and expenses. Okay. So B. Fisher invested $9,000 in cash. I'm just going to label this 1. B. Fisher invested $9,000 in cash to begin the business in exchange for common stock. So our assets went up by $9,000 cash, but our owner's equity went up. So right now, right at the very beginning, you're seeing that duality that I mentioned earlier, that at least two things always happen. Our assets went up and our equity went up. Before, it was my own cash. It was my personal equity. Now it's my shareholders' equity. Okay, number 2 says that I paid $2,850 cash for a 6-month lease on a van for the business. Okay, so this one is going to be a plus. Let me do this a plus here, plus 2,850 and minus 2,850. Why do I have a plus and a minus here? Because I paid cash, but I've got a lease that I haven't used up yet, right? So because I haven't used it up, I'm going to use it in the future. That lease is an asset. As I pay it down, or at the end of 6 months, probably at the end of 6 months, I will record that as an expense. Okay, number 3. We borrowed $10,000 cash from a bank and signed a note payable agreeing to repay it at 1 year plus 10% interest. So our assets went up by $10,000. Our cash, we got cash for that. But our liability, something we owe someone else, went up by $10,000. That's that duality. Here's the duality. There's the duality. Those okay, so number 4, I purchased $5,500 in cleaning equipment. The company paid $2,500 in cash, with the remaining due within 30 days. Okay, so on 4, my assets went up by $5,500 in the form of equipment, cleaning equipment, but they went down by $2,500 in cash that I paid. But the liability also went up $3,000 that I owe somebody else within the next 30 days. So that's a current asset. In number 5, see, now here's that duality. It said more, at least 2 things. In this case, we have 3 things. The equipment went up by $5,500. The cash went down by $2,500, and I owe somebody else $3,000. Okay, number 5, I paid $4,300 cash for cleaning supplies. So once again, I'm going to have a plus 4,300 and a minus 4,300. I got cleaning supplies that have not been used yet. That's an asset, an additional asset, but I had to give up some cash to get them. And so I'm down an asset, cash. Number 6. Oh, I guess we jump to the 7th. These are dates, not numbers of transactions. So on the 7th, I paid $350 cash for advertisements to run in the area newspaper during April. Okay, so this is April. So I've got I'm less 350. Now, this is where you get into the art of accounting as opposed to just the science of accounting. These are going to run in April. I'm going to use them. I have 2 choices here. Okay. I could either record this as an expense now, or I could record it as an asset because they're not used up. I'm going to record it as an asset because that's technically correct, right? Following the exact technical rules, that's correct. In the real world, if I knew if this is April 7th and I'm going to use these by the end of April 30th, in the real world, I'll probably call this an expense right now. Okay. All right. Then on the 21st, I billed customers $3,500 for services performed. Okay, so that's going to be an asset called a receivable of $3,500, and it's going to be a revenue plus $3,500. Now, revenues and expenses are a subcategory of owner's equity. Okay? And what I do is I net those out and it becomes an owner's equity. Then on the 23rd, I paid $3,000 cash towards the cleaning equipment. So here I'm less $3,000, but I'm also less that liability. This cancels out that liability right there. Okay. On the 28th, I collected $2,300 in cash from customers on their accounts billed April 21st. So I'm up $2,300, but I'm down this receivable $2,300. I have less receivable, but more cash on that. Then on the 29th, I paid $1,000 cash for dividends. So I'm less cash and I'm less owner's equity. Okay. On the 30th, I paid $2,750 for April wages. So I paid cash. So I have less cash. This is an expense. It's actually put. This is one that gets hard because an expense is a negative owner's equity, whereas a revenue is a positive owner's equity. So a negative expense is actually recorded as a plus. That one is a little difficult, I will grant you, when you're first doing it. 30, I paid $995 in cash for gasoline used in April. So it was for gasoline used in April. So it's already used up. So I'm going to have an expense of $995. All right. And so now what I've got to do is I've got to net these out. So I've got 3,500. Oops. Enter 2750 minus and 995 minus. I had 245. So I record 3,500 minus here. I record 3745 here, and then I will record minus 245 here. So these net out. So now this nets out to zero, and this owner's equity takes care of that. These together, say 35 and 35 is 0, 270, 374, 3745 and 2750, 995 adds up to 0. So these all zero out here. Okay, so that is recording it in the form of the financial statements effect template. Let me go ahead now, and we will take the same information and we will record these and then post them like we would in a manual accounting system. Okay, so on April 1st, we start with the date, and we're going to have cash is going to be $900, and then we're going to have owner's equity or shareholders' equity, $900. All right, now let me explain something. Whenever we put something on the left side like this, it's known as a debit. For our purposes, debit just means left, and this is a credit. If it's on the right, it's a credit. And credit, comes from the old French créditer, but for our purposes, it just means right. Debit and credit just means left and right in accounting. It really gets back to how do you add up pluses and minuses if you have a string of pluses and a series of minuses all in equation before the advent of calculators or computers. Well, you separated them into the plus side and the minus side, add them together, and then take one from the other. So that's what we've got here. And so this is my initial investment. In company. All right, then on the second, I paid $2,500 cash for 6 months lease on the van in the business. Oops, that was 9,000. I wrote 900. That should have been 9,000. Okay, so I have this lease on the van, that will be prepaid lease. $2,850, and then cash $2,850. So notice when I increase, anytime I increase an asset, it is a debit. Anytime I decrease an asset, it is a credit. Okay. Owner's equity increases as a credit. This is an asset. It increases as a debit. So this is a 6-month lease on van. Okay, and then on the 3rd, I borrowed $10,000 bank cash from the bank and signed a note payable. And so that's going to be cash, 10,000. I've increased my cash. I will have notes payable, $10,000. And that will be, let's see, it was for 1 year note, 10% interest. Okay. Then on the 4th, I purchased $5,500 in cleaning supplies, paid $2,500 with cash, with the remainder due in 30 days. So now I've got cleaning equipment. And it is $5,500. I paid cash of $2,500, and I have accounts payable. Because it's 30 days, we call it an account payable of $3,000. Right. Now we could put a note here, purchase of cleaning equipment. I think that's pretty self-explanatory. So on the 5th, we paid $4,300 for cleaning supplies. And I paid cash, like so. Again, that's pretty self-explanatory. We jump to the 7th. We paid $350 cash for advertisements to run in the area. So we would have cash, 300 and, whoops, we paid cash. So we would have prepaid advertising, $3,350, and then cash we decreased by $350. On the 21st, we billed customers for service performed. So we're going to have accounts receivable, $3,500, and that's going to be service revenue. $3,500. On the 23rd, we paid $3,000 cash towards the cleaning equipment. So up here we had accounts payable, $3,500. So we've got accounts payable. Accounts payable is a liability. Liabilities increase on the credit side. They decrease on the debit side. So we are debiting it. Those cancel each other out. And then we're going to have cash that we paid, $3,000. Okay, on the 28th, we collected $2,300 cash from customers on their accounts billed April 21st. We're going to have cash come in, 2,300, and we get rid of accounts receivable up here for 2,300. Okay. And then also, let's see, on the 29th, we paid 1,000 for dividends. So we're going to have dividend 1,000 and cash for 1,000. On the 30th, we had wages. This is going to be wage expense for 2,750. Expenses are always debits. And we paid cash for that, 2,750. And then finally, we paid $995 for gasoline used in April. So we would have gasoline expense, $995. And notice here, the tradition is if I'm making an entry on the same date, I don't have to redo the date. And then it's going to be cash or 995. All right, so now we have our journal entries. These are our journal entries that we've done through here, the first down to here. And now we're going to put these in T accounts. And what T accounts do, it's a manual form of a ledger. Okay, and so the computer does this for us automatically, but this is what's going on inside the computer. So the first one I'm going to put in here is going to be cash. And we have the left side is a debit and the right side is a credit. So I have 9,000 here and I check it off. Okay, so that means I have posted. This check mark means I've posted it. If I had a true ledger, what I would do is I would put the page number of the ledger that it was posted to. This is the only page, so it doesn't matter. And I'm going to come all the way down here and put in one called owner's equity. And we've got 9,000 there. And so I check that off and we are done with that one. So then on number 2, we have a prepaid lease of $2,800. That's going to be a current asset because it will be used up within a year. It was a 6-month lease. And so I've got this prepaid lease. And it was worth $2,850 there, and I had cash of $2,850. So there. So those two offset. Okay, then I borrowed money from the bank, was $10,000, so I added $10,000 to the account. And now I've got this middle column. These are the liabilities. And I'm going to have a notes payable. And the notes payable is for $10,000. Okay, so debit. One of the rules, again, remember accounting is a abstraction, so the rules, we make the rules always be true in that abstraction. Debits and credits must always equal. And if you look and see, we've got 1921,850 in debits. We've got 1921,850 in credits at this point. And so that's been posted. Then we bought some cleaning equipment. So that's a long-term asset. And we're going to buy that for $5,500. So that comes off of there. And we paid cash for $2,500. And we borrowed money. So this is an accounts payable. For $3,000. And so we mark those off as posted. Then we got cleaning supplies. That's a short-term asset. Cleaning supplies were $4,300, and we paid cash of $4,300, like so. So we mark those off. Mark those off as paid. Next, we had the prepaid advertising, another short-term asset. And that's going to be $350, and I paid cash for that, so $350 goes right there. And I will mark those off. And then we've got accounts receivable. And we billed our clients for $3,500 there with accounts receivable, and that becomes a revenue. And we mark that off. See the revenue there. There we go. So I set it up down here because revenues and expenses are what's called a temporal account, meaning that they close out at the end of the period. That's a temporal account that is an owner's equity account. Okay. So then we recorded the accounts payable we had the accounts payable when we bought the equipment, and we're going to pay off that accounts payable for $3,000. So we paid cash, and we had the accounts payable, and so there's our cash. Oops, still can't see it. There's our cash for $3,000, and then we record the accounts payable there for $3,000. And now I check those off. Those are all posted now. Then I received cash. Some of those people we billed for, what was it, $3,100 up here, $3,500 the accounts receivable. Some of them paid us $2,300. So now we have cash come in, $2,300, and And that was the accounts receivable. That'll be 2,300. That doesn't completely offset it, but it gets it down quite a bit. So those are posted. Then we paid a dividend of $100. A dividend is a negative owner's equity. I'm lowering my owner's equity and giving them the cash, right? So that and the cash is 1,000 up here. The dividend is the negative owner's equity over here. So now I record that as posted. Then I have the wage expense. So that's going to come over here. Expense was $27.50. And so that's a negative owner's equity account. And I paid cash at $27.50. And then finally, I had the gasoline expense of $9.95, and I paid cash for that of $9.95. Okay, now what I do is if I come up here and I've got these T accounts, and if I have any with multiple things in them, I need a balance. If I have these with just one entry in them, I don't need to do a balance. That's what the balance is. So I need to do a balance here. And so we do the 9,000 plus 10,000 plus 2,300. So that's 21,300. I'm just going to put this on a piece of scratch paper. Actually, I'm just going to store it in my calculator there. And then I need to do the credits. 2,850, 2,500, 4,300, 350, 3,000, 1,000, 2,750, 995. And so I've got 17,745 cash out. Recall the 21,000 and subtract those off. I have a balance of $3,555 in my cash account. All right. These are the balances here. This is the balance. This one I draw a line. And so I have a $1,200 balance in accounts receivable. I have a notes payable. This, I have a zero balance. I come down here. Okay, so I've got this. So I would take my revenues and my expenses, create a balance here. 3745. So I would write 3745 here. 3,500 here. That gets us to 0. That gets us to 0. These net out over to here to the owner's equity as a minus 245. So we lost $245 this month. And so that decreases our owner's equity. We also paid the dividend, so we get rid of that. And so now with $7,755 in owner's equity. Now, we can't say we lost $1,245, the amount of owner's equity, because we paid this dividend. So technically, that's not lost money, but that's what our journal entries look like. All right, I want to do the next one in your book. If I can find it here. The fan blew it somewhere. There it is. All right. So now the next one in your book, M13-13, these are adjusting entries, selected accounts for portage properties of real estate management firms or funds. So what happens? Remember when I said, remember when we were talking about the journal entry for the advertising expense, and I recorded as prepaid advertising? Well, it's for advertising for April. We're at the end of April. So now adjusting entries, another way to think of them are as catch-up entries. So I'm having to catch up what happened that I didn't put in the book. So they ran all the advertising. I'm happy they ran the advertising. And so now I no longer have prepaid advertising, but I have an advertising expense. That's a type of adjusting entry. So in this case, I would say advertising expense, $350, and prepaid advertising, $350. So that moves it from an asset to an expense. One of the definitions that is useful for expense is an expired asset. So I've used up the asset, it now becomes an expense. So let's go ahead and look at this next problem, M3-13, and we will look at some selected accounts. We have here prepaid insurance for $3,240, supplies for $1,540, office equipment for $6,240, unearned rent revenue $5,550, salaries expense $2,325, and rent revenue $13,250. So these are the accounts for this Portage Properties. They prepare monthly financial statements using the following information, adjust the accounts as necessary on January 1st using the financial statements effects template. So now we're back to assets, liabilities. Not spelling that good today. Owner's equity, revenues, and expenses. Okay. So our first one here, A, prepaid insurance represents a 2-year premium paid on January 1st. So it's $32.40. And so if that represents 2 years, that would be 24 months. So we used $135 up this month. So our entry would be assets will go down $135. The prepaid insurance is decreased by $135, and our expense went up by $135. Remember, expense is a negative owner's equity, so it's like it went down. So those offset correctly. B, supplies of 710 were still available on January 31st. So we look at the supplies, and it's 1540 was what we had. We did an count, and we had 710 still left. So that means we used 830 in supplies. So my asset would be down 830 supplies asset, but my expense would also be 830. Okay, C, office equipment. Office equipment is expected to last 8 years or 96 months. So we're going to take a monthly depreciation number on that. 6,240. Divide that by 96 is $65 a month. So the book value of our asset went down by $65, and we had depreciation expense of $65. Okay. Our next one here, D, on January 1st, Portage collected $5,550 for 6 months rent in advance from a tenant renting space for $925 a month. And so in this case, we've got the asset of prepaid rent. I'm sorry, that's a liability. Unearned rent is a liability. So that's going to go down by $925. Why is it a liability? Remember, a liability is something that we owe somebody. And so if something happens, like a tornado comes through and they can't use that building, they pay me the thing, and before they move in, a tornado comes through and there's no building for them to move into, I owe them their money back, right? I have not got a viable building for them to lease. So they even though they paid me, they get their money back. Well, you also remember I said not all liabilities have to be satisfied with cash. So in this case, we're satisfying the liability, the prepaid rent or unearned rent, by allowing them to use the building for a period of months, in this case, 1 month. And so that went down 925. So we reduced our liabilities by 925, and we increased our revenue by 925. Hmm. And then the last one, E, salaries of $490 have been earned by employees but not yet recorded on January 31st. And so we're going to have an expense of $490. $490. And we owe them that money, right? $490. All right. So I'm going to do the exact same work, only in the form of journal entry. So this is M13.4. Refer to M13, prepare the journal entries for parts A through E. Okay, so now we would have prepaid insurance represents, that would be the, we would have insurance expense. Expenses are always debits. So it's 135, and we get rid of prepaid insurance for 135. That is a credit. Okay, so the next one up is supplies of 710 were still available. So that means we used 830. So that would be supplies expense. And we would just get rid of supplies for 830. Okay, great. The next one is office equipment is expected to last 8 years or 96 months. We figured that was $65 a month. So we will have depreciation expense for $65. Now this is a new account. This is called accumulated depreciation. Accumulated depreciation stays, I call them marriage accounts. So it stays with the equipment. Remember we talked about book value. Book value is the historic cost minus the depreciation. And so this accumulated depreciation is called a permanent account. We get rid of it when we get rid of the equipment. We sell off the equipment or dispose of it some way. Get rid of it. Depreciation expense, on the other hand, is a temporary account. We close that out every accounting period. But this accumulated depreciation stays long. And it has a special name. I'll just kind of draw it over here. It is called a contra asset. There's a couple of these out there. A contra asset just means that its balance is the opposite of most assets. So most assets increase on the debit side. A contra asset increases on the credit side. It's really a negative asset, so it lowers the value of our assets. That's a contra asset. On January 1st, we collected prepaid rent and for 925. So we will have rent revenue be $925 a month, and we will get rid of unearned rent for $925 a month. And then finally, the last one, we have salaries of $490 have been earned by employees, but not yet recorded on January 31st. Okay, so we're going to have wage expense, 490, right? That's that one up there. And then we'll have wages payable. That's that liability, 490 right there. And so those are adjusting entries. You'll notice most of the adjusting entries had to do with some type of expense, insurance expense, salaries expense, wage expense. This was a revenue, right? But most of them have to do with expenses. And so those are adjusting entries, and we have to do those before we can prepare the financial statements. All right, so I'm going to stop here on this one, and we will talk to you later.